Your financial habits are already in line with the infinite banking concepts principles. You're already doing it. It is just how you do it that's different.
But here's the thing, it's uninterrupted compounding where we can still take that money and pay debts. We can take that money out, invest it. We can take that money out and use it for major purchases.
This is why the wealthiest families throughout history have done this. The best way to predict your financial future is to create it. And to create it, let's do it together. Welcome back. Thanks for joining us for another week, another wealth webinar. I am pumped. I got Mr. Craig Yenny in the house, our advanced market strategic strategist, as somebody called him today, but actually our advanced market specialist. Handles a lot of our advanced cases for us and also puts together all the material for these wealth webinars. We got Mr. Snaggy rolling in with the new BYOB hat, and we'll put the link up if any of you want to capture one of those suckers. But today we are going to talk about unlocking your inner banker. Sounds a little unique, right? Unlocking your inner banker. And we're going to talk about your habits. So much of what we teach, and just so, well, actually here, pause. How many of you are here for the very first time? We got 100 people on here. If you're here for the first time, put I in the chat. I want to find out who's here for the first time. We got Sam for the first time. Welcome, Sam. We got Shirley. We got Carrie. What's up, Carrie? We got Raphael. We got Thomas. We got Miss Mark. We got Veronica. I think that's it. Isn't that Veronica? Veronica? Yeah, that's a very unique spelling. Linda. What's up, Linda? Aretha. Love that. Aretha Franklin. We got Felix. Felix, this is not your first time. That cat's been here about 1,000 times. Well, maybe not that many. We got Arthur here for the first time. We got Mrs. Johnson. We got Johnny. We got Eddie. All right. Welcome, welcome, welcome to all of our first timers. Thanks for joining us. This is very simple. On the Wealth Webinar, we talk about one thing and one thing only, and that is money. But more specifically, talk about how to take back control of your money by teaching you how to be your own bank. And that is the fundamental of what we're going to do today. Now, Wealth Webinars, we cover lots of different topics. I mean, we cover things like treasury bonds, how to preserve your capital and your wealth, how to build your retirement, guarantee it, and reduce risk in it. But today, we got to go back to the basics. Not so much the basics, but we got to go back to your current financial habits, which I guess some of you could say are your basics, because everything we teach about being the bank is simple. And I know some people are like, oh, it's so complicated. All the numbers, they don't understand it. Listen, from the fundamental basis of what we do, it's the exact same thing you're doing today. Every single one of you, whether you've been here hundreds of times or this is your first time, everything we teach is the same as what you do today. Literally, there's no difference except this. To do what we're going to teach you, it requires changing one thing. That is where your money goes first, and adding one step to how you use your money. So as long as everybody here is capable of changing one thing and adding one step to your life, everything you're about to see is possible. But unfortunately, we have been conditioned, we have been lied to, and we have been taught that money works one way and it is the wrong way. But we've been taught to give up control of our money to benefit the banks, Wall Street, and the other institutions. Now, I'm not sitting here trying to point at them and say they're all bad. I use banks. Listen, I use Wall Street. I used to be a financial advisor in Wall Street. So we use all of them, as do I. However, we need to understand how money really works. And we need to understand that our habits around finances are broken, but they're very easy to fix. So I think that's the fundamental part of that. And I'm going to open up today's Wealth Webinar with a story. Some of you have heard this, but since we got so many new ones, I think this will be really good. So I always like going back to where did I first learn about this? Now, little context, in my past, I was a financial advisor. I entered the financial advisory role, I always call it the Wall Street world, in 2003. And I was there until 2018, roughly about 16 years I spent in that hellhole. But anyway, doesn't matter. I learned a lot, and I've had to unlearn a lot since I left. Now, I left in 2018 when me and my wife we were getting a show on HGTV, and we got it approved to air, which means I need to go back to my compliance officer and I need to get approval for what's called an OBA, an outside business activity. And when I told them what I was doing, they said, you can't be an advisor. So that's when I left Wall Street. But the real question and the real story that I want to get into is, how did I stumble upon the infinite banking concepts? How did I stumble upon this be your own banker? I promise you, I'd never, ever, ever learned about this when I was a financial advisor. Not once, not one of the consultants on any of the different levels that I was at as an advisor taught me what you're about to learn. But the person that did was not who you would think. His name was Mike. Now, in my past, I was a pro snowboarder, and I happen to visit Utah quite often, which is one of the reasons we're going to Sundance next week, because I love Utah. I was out there snowboarding, and this guy, Mike, who I knew and I knew had a lot of money, he was one of the guys that funded some of my real estate flips, because me and my wife were flipping houses at this time. This is 2014. So I'm out there, and I call up Mike, because I was in his backyard, and I said, hey, Mike, I'm in Utah snowboarding. I was wondering, could we get together for lunch or sometime whenever it's convenient? I've got a deal I'd like to show you. Now, I knew I was going out there, and I'd always bring whatever deals I needed funding for, because you never know who you're going to run into, and you might want to pitch a deal to get some money. And I had a deal I needed money for. So Mike met me at Cheesecake Factory, downtown Utah. We're sitting there, we're going through this, and I'll never forget, I don't know why, but instantly I kind of had this question, and I asked Mike, I said, so Mike, how do you lend on all these deals? I'm a financial advisor at this time, I'm thinking, and I'm like, I got to know how he does this, but I want to learn more about this bank thing. And he, without a flinch, he said, I lend from my private bank. Now, right there, Craig, if you had heard that at Cheesecake Factory, what would be the first thing that came to your mind? I lend from my private bank. What would you think?
You probably have a bank somewhere in a community. You went through and got a bank commission, did all the paperwork. It's complex. I don't understand it, but that's cool. You must be really rich.
First thing I thought is, holy shit, Mike's got a lot more money than I thought. This dude owns a bank. I knew he was multi-generational, and I'm like, well, hell, I guess maybe they got a bank. So I said, so Mike, when we're done here, let's go to your bank. I just would like to see it. He said, no, I don't have a bank. I mimic what a bank does. I'm like, well, that's interesting. Well, you keep going. And he says, Chris, all I did is I changed where I put my money. I don't put it in banks. I put it into another institution that pays me guaranteed interest. And I'm like, guaranteed interest. Okay, got that. Now remember, as an advisor, and many of you are the same, you compartmentalize things that you know, that you've learned throughout your life. So what I did is I took that word guaranteed and I said, okay, what vehicles are guaranteed? Fixed annuities, CDs, bank accounts, like all these different things. So I had that box. Then he continues on. I'm going to go faster. And he says, and I get paid dividends every single year. So I'm like, okay, Mike's getting guaranteed interest and he's getting dividends. Okay, all right, got that. And he says, and the dividends and interest grow tax-free. I'm like, oh, son of a pup, what the heck could this be? Interest, dividends, and tax-free, maybe a Roth, you know? And then he goes on and he says, and my money's protected against judgments and liens. And not only that, if I die tomorrow, my family gets a big check. So I create a legacy. And I'm like, what in the world could this be? But then he drops a bomb on me and he says, Chris, here's how it works. So when you come to me with a deal like this, what I do is I go to my banking system and I take a loan from my bank and I give that money to you. And then you pay me the interest rate, 15% that we've agreed on. And I take the interest you give me and I put it back into my private banking system. So in other words, folks, I'm a very visual thinker. So let me give you the visuals behind this. So Mike had a private bank, which I still don't know what it is, but I know it's guaranteed interest. Okay, I know it pays dividends. I know it's tax-free. I know it's protected, and I know it has a legacy. So these are the things I know at this point. Mike then alluded, he takes a loan from his bank, and he gives me the bank, or gives me the money that I need for my real estate deal. I pay him 15% interest. He takes my interest, and he puts it back into his bank. Makes all the sense in the world. Folks, every one of you do this every single day. You go out there, you save money in their bank. You then use your money to go out and do things like investments, and you take the money from the investments and you put it back into their bank. It's simple, right? Everything I just explained makes sense. But now I was super confused because I'm like, where did he find a bank? But he said it's not a bank that pays guaranteed interest for the rest of his life, dividends, in a tax-free environment, protected against judgments and liens, that provides a legacy. What in the hell is this? Mike goes on to tell me, he said, Chris, when I took the money from my private bank, I didn't use my money. All of my money was there. So let's just say I need to borrow $100K for this $100,000 real estate flip over here. Mike takes $100,000 out. Remember, it was a loan So he takes that loan for 100K from his private bank and gives it to me. But then he says, my 100K never left my account, which means if you're paying attention, Mike had 100K in his private bank, still earning interest, still earning dividends in a tax-free environment, while over here, his money is working for him again in my private lending deal, which, just so you know, was a first lien position at 15%. So wait a second, Mike, hold on. If I'm capturing this right in my head, you're telling me you're making money twice on the same dollar, which he was. Because if he's making interest and dividends on the 100, that money's working for him. But then he took that money out, this loan thing, which I don't understand yet, and he lent that money to me at 15%. So his dollar or his $100,000 is making money twice because he's making this plus this. And the only thing he didn't explain to me, which I'll explain to you, is to borrow that money from his banking system cost him interest. But the interest he was paying back when he did this was 4%. Today, that interest is actually 5.5, somewhere around there. But the guaranteed interest and dividends he was earning then was 6. So if he was making 6, and back when he did this deal, he was paying the insurance company 4, because it is an insurance company that he was using, cat's out of the bag, what was he doing in the middle? Well, he was doing the exact same thing a bank does, and he was making a spread. Because listen, folks, make no two ways about it. Every one of you, when you deposit money in the bank more than likely pays you interest on your money. True or true? And when the bank pays you interest on the money, what does the bank do with your money that you just deposited in their bank that you gave up control of? Well, because you gave up control and you gave the bank control, they take your money and they lend your money out. Do they lend your money out at a lower or higher interest rate than what they're paying you? Come on, play along here, folks. You guys did so good when I asked who was new. Do they lend it out at a higher interest rate or a lower interest rate than what they're paying you? If the bank is paying you 3% on your deposit there, how much are they charging you on a loan? Well, that varies, but it's way higher. I like that answer, right? So are you not doing the exact same thing in the reverse order of what you're doing today? You are becoming the bank. Mike was becoming the bank because he was earning 6 on his money, dividend crediting rate. He was paying 4 to borrow the money from the giant mutually owned insurance company. So indeed, he was making a spread on that money. And then that's not, the spread wouldn't really work out to be 2%, but just mathematically, I'm just showing it because you got cost of insurance, commissions and that. But in that scenario, it depends on the year, which we're going to get into today, what his spread would be. But nonetheless, he is making a spread, which means he is making money twice on the same dollar. Fundamentally, this is what we're going to teach you today. This is what we teach every week in different ways, in different scenarios. But again, the main thing that I want to get across today is that you have to change your habits and how you do things, because your habits will definitely dictate whether or not you are successful or not successful doing this. Shauna always gives me these little notes. So when I'm looking down, Shauna kind of gives me little notes with these little asks. So here is her ask, and I want all of you to participate. Fair enough? Okay, she said, have you ever felt like you're working hard to manage your money, but you're not seeing your money work hard for you? How many of you feel like that? How many of you feel like you work really hard? You trade hours for dollars to make your money, and you work hard to do that, right? But how many of you feel that your money is out there working just as hard as you are? Anyone? We got 9 folks. Let's see, 100%. Yes, yes, I did all the time. Yes, 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 almost. Great. So I've got the right audience here. Great, let's dive in. So this is like a little thing that we put together. Everybody can see that all right, right? We're gonna fly through this, but I think this is a really good place to start. So are your current practices aligned with the infinite banking concept? That's the fundamentals of this. And really what she was mentioning, she came up with 10 common financial behaviors. And when I say she, I mean Shauna, okay? And it all comes down to habits. So the first thing I wanna hit, and I'm gonna bounce back and forth between the whiteboard and this, but right here, paying down debt aggressively. Okay, this is commonly known as maybe velocity banking. Christy Van teaches this on Fantastic. This could also be people that use the equity in their homes to pay off debt. This is a very similar thing. That's a common use within velocity banking, but it is also behavioral, because no matter what, whether we are paying down debt aggressively using velocity banking, using HELOCs, maybe using avalanche or different methodologies like the snowball, It is a habitual thing. It is something you have to train yourself to do because we are not taught this. We are not shown this. We are taught to just go out, make money, spend money, make money, spend money. And too many folks, according to statistics, go out there, make money, and spend more than they make because they use credit cards to buy a lot of what they do and to maintain their lifestyle. Now, I know that's not you folks on this webinar. We got 131 people here, and I know you are all the 5%. You are not the conforming 95%. So you're different. But the average person, the majority of every person you're ever going to meet are those 95% because that's just math. According to Social Security, out of 100 people, only 5 are going to be financially successful. You all make up that 5%. But what about the other 95%? Those are the ones that you're going to come into after you see this, after you start practicing this, after you become your bank, and they're going to say, oh, there's no way that works. Be careful. That's a scam. That's too good to be true. There's no way anything could work like that. That's because they haven't learned, because they've just conformed to what they've been taught, and they just accept that as the only way money works. None of the 131 people would be here if you are conforming to accept the normal. If you would not be here if you are just like, hey, that's the way it is, the way it's always been, and that's what I'm going to do. And if that was you, you wouldn't be on this webinar. So congratulations to each and every one of you. So right here, as you can see from the screen, behavior. People making substantial monthly payments into a HELOC, personal line of credit, or credit cards with the goal of debt elimination. Let me stop sharing, and I want to draw this because I think a lot of what I do well is I visualize and show you how these work. So I got a great way to show this, and let's just do it over here. So most of you on this webinar have a house, okay? So we got a house, and that house, for most of you, has equity unless you just bought it. But how do we extract that lazy money that's sitting in your walls? How would you extract that? You'd go to a traditional bank. You would apply for a home equity line of credit or a first lien HELOC if you're really smart. We're not going to get into that today, but we'll have that covered in another webinar. And you're going to get the equity. Typically, they will give you 80% of the value of your house. So if your house is worth $100,000 and you've got if your house is worth whatever it is, but it's $100,000 in equity. So let's do that. You got $100,000 in equity in your house. The bank will give you $80,000. Okay, 80%. First lien HELOCs can go up to 90. So now let's say over on this side, and I'm going to draw it like this. Okay, we're going to do an arrow here, and we're going to do an arrow here because I want you to visualize this and I want you to understand how I'm doing this so that this makes this super easy. In your house, you had lazy money that was sitting there to the tune of 80 grand. And let's just say over here you have debts. Okay, and let's say it's a car loan, you got credit cards, a line of credit, and you got some other things. But those debts over here, for simple math, are $80,000. Okay? Now, that $80,000 is costing you $1,500 a month and averaging, when we average all these loans out, let's just say it's 9% interest. This is your math. This money is leaving your family every single month. You are giving up 9%. There are lots of you on here who would literally be thrilled if you could earn 9% on your money every year without any volatility, right? How many of you right now would be thrilled if you could make 9% on your money with zero risk and every year you got 9%? No ifs, ands, or buts. How many of you would be right there? This guy, look at that. Holy cow, I can't even keep up. There we go. So I think that's a true statement. But here's what people don't realize, and this is where I always tell people, like, you're doing this already, your just habits are totally wrong. This is normal for people. It's normal for people to have a car loan, credit cards, line of credit, a mortgage, and pay $1,500 a month. And if you added up all your debts and divided them out by the number of debts, that's probably low for what people are paying, 9%. But you all just told me you'd love to make 9% guaranteed. Well, it's easy. You're giving it away. Become the bank and you have 9%. Find a way to pay off all these loans, and that 9%, all you need to do to earn it is pay this back to yourself. So how would that work with a HELOC? Well, it's simple. You'd extract the HELOC, the $80,000. Now let's just say your HELOC costs 7%, because that's probably about right for today. About 7% is what the bank would charge you to use the equity in your house. But they gave you 80 grand and you just so happen to have $80,000 in debt. So what we would do is take the loan from the HELOC. We would pay off all the debts. We would take the payment you used to make to all your debts, $1,500 and you would pay it back over here. So every single month, $1,500 would go back to the home equity line of credit. And here's the cool part. You are making a 2% spread in this. So you literally just made 2% arbitrage because you took zero risk. And nothing really changed. Money came from your house, paid off your debts. Payments to your debts went back to your home equity line of credit. Easy to understand, right? Super easy. So when we're talking about habits, I'm going to share my screen again, and we're going to kind of go faster now. When we talk about habits, that's how it works. But how does this align with IBC, with the infinite banking concept? Remember that story of Mike, the uninterrupted compounding interest? Well, if it was, what you would do is redirect the money. Instead of paying the debts off, you would redirect it from that first lien HELOC into the policy, then pay from the policy. And why would you do that? Well, because the policy, that specially designed and engineered whole life that Mike was talking about, continuously and forever will pay you guaranteed interest and dividends even while using the money. So over a period of time, all of that money would continue to compound. Instead of this scenario that I just did on the board, the money goes from the HELOC, pays off the debt, and comes back to the HELOC. Yes, you net 2%, but your money wasn't working for you twice. But that's the habit. That's what you've been taught to do. So you're already prioritizing cash flowing efficiency and debt payments, like it says right here. This is the conclusion. But with IBC, you create a system where you borrow from yourself, and the payments and everything else stay the same, but they go back to your bank. So that's the first thing I wanted to cover. Now, this one's kind of cool. Dave Ramsey. We all know Dave Ramsey. He's kind of pioneered this envelope system. So right here, we call this a sinking fund or the envelope system. You all know how that works. So let me just draw that one out. So it's going to be the same concept. I just got to clear my board while you guys look at that screen here real quick. So we're going to change up a few things here. Now, this is what we're going to talk about. Sinking fund is one word and the envelope system is another, but I want to kind of draw this for you. So now how this would work, you with the envelope system, we're just going to draw an envelope here. Okay, Dave Ramsey's envelope. What you do is you take money every month, week, he does it a lot of different ways, and you put it in the envelopes. And you just keep saving up in these envelopes until you have enough money to pay off. And he does the snowball, which is low balance to high balance. So what he would do is save up the money in the envelope. Then when you had enough, he takes the money out of the envelope, comes over here, pays off the credit card. When he pays off the credit card, he takes the amount you used to pay to the credit card, call it $50, and you roll that money back into the envelope. So now we got 50 plus the money you're saving. So let's just say you're saving 100 a month plus now you're recapturing $50 from that credit card. You just keep repeating this over and over again. Very slow, but it is effective. And we're going to show you the math behind this today. It is effective. You definitely will pay your debts off faster using his envelope system than you would if you just followed the normal procedure that you've been taught to do with paying your debts off. However, imagine this. Imagine you went to, I don't know, let's pick a store, Walmart. What the hell? You go to Walmart and you're in the envelope aisle and you're just walking and you're looking for envelopes, probably the cheapest one, but then right there is this box. Okay, this box, and on the front of the box, it says envelopes plus interest paying ability. These envelopes in this box pay you interest. And you're like, well, that's a unique concept. So you buy those envelopes, you come home, you put the money that Dave Ramsey told you to put in the envelope, but now when you take the money out, you're taking not just your savings, but your savings plus the interest that you got paid. That is the same idea is what we're doing with the policy, except for we're not using envelopes. We didn't have to go to Walmart and find a fictitious thing that pays interest because there's not an envelope in the world that pays interest. But there isn't a mutually owned insurance company, life insurance company, with a specially designed whole life that does not pay you guaranteed interest. So we just got to change the name. It's not an envelope. It's a specially designed and engineered whole life. Okay, so again, it's just habit. First habit you learn from Dave Ramsey is the envelope system, and you learn the snowball, and you learn how to systematically save money and recapture money. It is brilliant, but what we're doing is we're supercharging that by making it so that those envelopes, not envelopes, policies, pay you guaranteed interest plus dividends in a tax-free environment. That's it. Sinking fund we'll cover a little bit. I'm not going to get into that. That's a little bit too much to unpack here. So right here, the next one would be emergency funds. How many of you have an emergency fund or pay or put money into an emergency fund, a bus fund, whatever you want? Put I in the chat. Every day Nick does it. Okay. Celeste does it. Troy does it. Yep. So perfect. So you're already doing this. So again, all of you have an emergency fund. Can anyone tell me how you do your emergency fund and how much you keep in your emergency fund? And you could copy off what we put, 3 to 6 months, but what are you all doing? Anthony, how much you keeping in your emergency fund? 6 months of living expenses, 6 months, perfect. Like clockwork, 50 grand, I like that. Some people just have a flat dollar amount. Use a HELOC, we're gonna go there. I try to avoid emergency, 6 months. All right, so most of you are keeping like between 3 months and a year or a flat dollar amount. And I love it. Leah comes in like as the reigning champ at the end. Leah's like 37,000 bucks, but it's in my whole life insurance policy, which I don't know if that was pre-planned, thought out, but that's exactly what we're saying. If you have an emergency fund, which many of you just said you did, you all have a strategy and a behavior around your emergency fund, a specific amount of time of living expenses, a flat dollar amount. All of you have some. Shauna has a flat dollar amount. I'm a flat dollar amount person, which was derived more from living expenses. But nonetheless, you all have a habit, a financial habit of saving money in case the unforeseen happens. You know, sewer line plugs up, furnace goes, roof goes, house burns. I said that because last night one of our rentals caught on fire. So you all have an emergency fund, but what if you changed where your emergency fund money went and you put it into a specially designed and engineered whole life that paid you guaranteed interest, dividends in a tax-free environment, protected against judgments and liens, and provided a legacy for your family? Would that not be a better place to keep your emergency fund? Well, whether you say yes or no, it definitely would be. But it would not be the smartest place in the first 2 or 3 years, which we'll get into in just a bit. Number 4, practicing frugality and financial minimalism. How many of you like that, right? Dave Ramsey's eat rice and beans, and when you're sick of rice and beans, eat beans and rice. Now, unless you're Chris Naugle, who beans and rice is my favorite food there is. I like it more than ice cream. I like it more than raspberries, and that's a tough bet, but I love my rice and beans. But most of you don't. But how many of you want to eat rice and beans or beans and rice just to be financially minimal, just to get ahead, to save? Well, the thing is, it's funny because a lot of people do. You know, Dave Ramsey and so many of these other gurus will tell you, oh, don't go to Starbucks. Don't drink coffee at Starbucks. Just make it at home. I'll be the first to say, the coffee I make at home does not taste as good as the shit I get at Starbucks. Yes, the Starbucks stuff is like 400% more expensive, but man, does it taste better. I want my Starbucks, and I'm sure all of you do. So when you're practicing frugality and financial minimalism, maybe the thing we really should do is just change our behaviors around money and avoiding unnecessary expenses, focusing on living below our means, which again, I told you nobody wants to do that. You could, or you could just align yourself with a system that allows you to save and spend at the same time, that allows your money to continuously forever earn for you, or work for you is what we like to say. So down here, this is what Shauna put down. Your frugality shows you're already focused on financial efficiency, and IBC just amplifies that by creating a system where every dollar works harder for you. Again, I'm just trying to get you through these. These are habitual things, folks, things that all of us do. Okay, utilizing high cash flow for investments. So regularly putting your surplus cash into investments. A lot of you invest money. Many of you are probably on private money club, lending money, making your money work for you, getting a cash flow. But if you did that using the policy, first, change one thing, that's where your savings goes first, and then lend from your policy, invest from your policy. Just like I showed you with Mike, your money works twice. Every dollar is working for you twice instead of once. This is efficiency, okay? No matter how you're doing it for high cash flow or investments, so many people will compare what we're talking about, and they will say, well, why, Chris, would anyone put money in that stupid whole life when I can put money in the S&P 500 and make 23% like I did last year? Why would anyone put money in that stupid whole life and make 4, 5, 6, 7% when I can put money in NVIDIA, and lose 17% Monday? But who's keeping track, right? You made money in the past, so it's always going to make money until a Chinese company comes out and shows that they can do it for a fraction of the cost better. Anyway, getting off topic. You would have had to have been on WTF to understand it. But anyway, the conclusion is you're already focusing on building wealth. IBC just gives you a way to grow your money in multiple places at once and protect your family. The final thing, and this is something I'm going to really go deeper into, the final two things here. Number one, automating the financial process. But let me kind of come down to number 7 here and hit building equity in assets. Here's something that I think a lot of people miss. You save money. We're just going to pick on a bank. Okay, let's just call this a bank. It could be your bank or their bank, doesn't matter. How many of you set up automatic investments from your bank account put in there? So in other words, from your bank, you automatically transfer or do bill pays, or I don't want to use bill pays, but transfer automatically on a monthly basis, save money in something like, we'll just put investments. How many of you are doing that? Put I in the chat. Okay, some of you. No way, don't trust the bank to do that right. Janice, all right, on a weekly basis. Yeah, maybe during Christmas, you got a Christmas club, or maybe during Christmas, you're saving up for Christmas. Maybe during the year, you're saving up for college for your kids in a 529. A lot of people automate their investing. I am one of them. So every single month, I have money go from my bank account, okay, my true bank account, and I have that money go into a Charles Schwab account. Now, that account was set up to pay my taxes. Fell a bit short, but nonetheless, that's what it was designed to do. Every month, money would transfer from there automatically, out of sight, out of mind. And then from Schwab, I would invest that money in things like T-bills. But how many of you also set up bill pays? I bet you a lot more of you do this. How many of you set up bill pays to pay all your debts and all your expenses? How many of you do that? Debts and expenses are paid with bill pays. Put I in the chat. What do we got, Craig? Got a lot of people doing bill pays?
Yeah, there's a lot of bill pays.
Quite a few. All right, so one of the interesting things here about doing automation is by doing this, you eliminate habitual habits. Also by automating things, you get rid of that emotional side of investing or that emotional side of paying debts. You know, I remember a long time ago, we had a client when I was back at New York Life, and last story I'm going to do, and then we're going to really dive into this because I'm taking too long in this section. But this client had just gotten divorced. He was a high net worth client. Okay, he wasn't my client, it was my partner Mark's, and he was worth a lot of money, tens of millions of dollars. Got a divorce, and in the divorce, obviously, the spouse, his wife, got a judgment or whatever you call it to get a bunch of money per month. So every month, she was going to get like $20,000. The guy made a lot of money. She's going to get $20,000. This client, when he was sitting down with Mark told this story way better than me. He said, I physically cannot write her a $20,000 check. I just can't do it. My hand will go to the checkbook. I'll start shaking. I can't do it. I hate the lady. She ruined my life, blah, 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 whatever. I'm elaborating. He could not write the check. So Mark was like, hey, no problem. How about this? Let's take that chunk of money that you've just got sitting there, right? And let's take that chunk of money, and that's the money that you got to pay her out, but you got to pay her monthly. And let's put that money into this vehicle. And he was alluding to an immediate annuity, but forget about the vehicle. Let's put it in here where the insurance company every single month will send a check to her. But because the insurance company is going to pay you interest on that money every single month, you're going to have to pay her less money than what you were supposed to, because the insurance company is going to kick in and pay some of the money to her. How about that? And the guy was like, I don't have to write her a check, and the insurance company is going to pay her some of this alimony? Sign me up. So what he did is he automated his alimony checks to his ex-wife. He was thrilled. It saved him money. It was out of sight. No more emotions, out of hand. I don't know why I mentioned that, but seriously, that is habitual. The person couldn't write the check. There are a lot of bills you pay every month that you probably get the jitters. You probably don't want to pay because you're like, son of a bitch. That, you know, like debt consolidation loans, those are the worst of them all. Like, you hate paying for them things. I hate paying health insurance because when I call the doctor, you can't even get in to see him anyway. So what the hell am I paying for? Anyway, I digress. Automating this will help you tremendously. So as we get into IBC, let's just say instead of the bank, this is your bank. Okay, you set, you know, you don't need to automate the loans because you find things you want to invest in. So we take a loan, okay, from the policy. And what we then do is we automate the money coming back. So everything with my banking system is on autopilot, except for the money going out. which you could automate that. You can set up systematic loans coming from your policy or systematic withdrawals, but we're not going to go there today. But that's the only manual part, is when I need money, I go in and I take a loan from the policy. But when that money is generated over here, let's say on PMC, I get interest, I take that interest and I set up an automatic loan repayment back into my policy so that it is out of sight, out of mind. And you know what happens when you automate this system using infinite banking? Your cash value just keeps climbing and keeps climbing. And you know what? Eventually you'll have the same problem that I have. I talked to Craig about this. He's got a bigger problem than I do. Your banking system, your policies have more money in there than you want to put out. I have that problem going on right now. I have hundreds of thousands of dollars, I'm not bragging, sitting in my policies, and I don't know where to put it. And some of you are like, what do you mean you don't know where to put it? You had this guy on with this, you had Rockstar, you had this investment. Yes, but I already have those. I am right now risk averse. I don't like what I see in the near term in the economy. I talk about it every single day online. So I am sitting on cash. I'm just sitting on cash in my policy. But do I think, is that a big problem for me if I'm sitting on cash value in my policy, where the average policy that I have, I think, is making double digits right now because they're all older? Actually, how about we just do that real quick? Super fun.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
I'm going way off script, folks. Shauna's going to be upset with me because she's like, I put this awesome plan together for you, and now you're way off script. But I think this is relevant because up to this point, I have not talked to you about what the returns on these policies are. So I think it's probably time for me to show you this. Can everybody see this? This is one of my policy statements. I just got it. Actually, my policy date is 1/26. So I started this policy January 22nd. January 26th. What is today's date?
It's the 29th.
So I'm off a couple days, but that's when I started this policy. I started this policy in 2022, and I put $1,250.10 every month into it. How many of you think that that is an automated transfer? Do you think I write a check for $1,250.10 into my policy every single year? No, it goes from my checking account, automatically sweeps through what's called an ACH transfer into my policy. And I've been doing this since 2022. Now, I'm not going to get into the loans because the loans are always out on this policy, but can I just go over right now how this policy is performing? So we're going to go 2024 to 2025. And I'm literally going to read the numbers right off here. And if you all think that I'm making numbers up, I'm happy to put this closer or pull it away so you can see what the numbers are. But just let's go with this. So in this policy statement, so if we add this up, it's roughly about, what does that work out to be? Craig, can you do the math? 1250, 10 times 12. Tell me what per year I'm putting into this thing. All right, so here we go. We've got,
$15,000.
how much?
$15,000 a year.
Okay, so we're doing $15,000 a year. That's going to be important in a second. That's my premium deposit. All right, so in 2025, my ending cash value, which means on 1/26/22, or I'm sorry, on 1/26 of every year, that's my policy anniversary date. So in 2024, I had $101,693 and change in that policy. That was my cash value. In 2025, just 1 year later, after putting $15,000 into the policy, I now have $119,767 and change, okay? So right there, I know that doesn't mean anything to any of you because you'd have to do some math. So let's do the math. How you would do this is you would subtract 101. So we subtract the cash value from 24 from the cash value from 25. So if we do that, that means that you'd come up with the same number here, and you guys can check my math, $18,073.93. So let's see, 2022 to 2025, I've been in this policy 3 years. So I'm 3 years in. I want to be very clear. There is no dumping in this policy. I did not dump money in. This is just monthly. I just do monthly deposits. It says it right on here. I grew $18,073. I put $15,000 in. So if we wanted to figure a cash on cash return and figure out what is the health of this policy 3 years in, well, if we put 15 in, but we grew by 18, well, then I would subtract the 15, right? Because you can't count the 15. That's my new deposit into this account. Notice I said, a lot of people want to say, well, you invested 15,000. I didn't invest shit. This is a savings because it is guaranteed. And in order to be called an investment, a lot of people get this wrong. In order to be called an investment, it has to have risk. There is no risk because it is guaranteed. So I just want to clarify that. So over here, if we did the math, my net, I always say net gain in this policy is $3,072.73. Okay? $3,072.73 net of commissions. Because this policy, this is the third year with this product, we still get paid a commission on this. Net of cost of insurance. As of right now, my death benefit is $735,248.41. I don't know if you could see that number there. Okay, so I got a nice death benefit. If I die tomorrow, my family, just from this one policy, gets $735,000 tax-free. So now, if I wanted to figure out what my return was, how would I do that? Craig, you know how to do this, but how many of you on here would know how to figure out the cash-on-cash return? Because all the math is on the screen. I just want to check and see if anyone knows how to do this. I see you guys are answering questions. So how about this? Marva Warren, welcome to the Wealth Webinar. If this was your policy and you knew that your net return or growth was $3,072.73 and you put $15,000 in, but you want to know what was my percentage return that year? We call that cash-on-cash. Marva, what would I do? Anyone want to chime in and help Marva? And this is great. Leah just got a whole life, so this will help you because now you can run your math. I do this all the time in reviews, did it twice today. You divide the net gain into the amount I put in. You would do this in your 401k, in your Schwab account, your Fidelity account. That's how you do it. Can anyone do the math for me? Because I don't want to give it to you. I want somebody to do the math. What is it? How much of a return did I make 3 years into this stupid whole life that Dave Ramsey says nobody should ever put money into these stupid things because they're awful? $3,072.73. Oh yeah, look at that. Shane, I don't know how you got 120% return, but I like where your head's at, but we're off a little bit, but they got it. 20.4%. $3,072.73 divided into 15,000, 20.4%. But you know, these insurance companies are greedy, so let's not get ahead of ourselves. I know that's an impressive number. These insurance companies, they're a little greedy. So hold on, I got to go to the back page here. And I got to read you this. All right. The loan interest rate that this insurance company charges me on this policy, let's see. The loan rate for this policy year covered by this statement is 5.73%. So I really didn't make 20.4. If I took loans out, look, if I put this 15 in and took this 18,000 out, which is what we teach, the insurance company is going to charge me 5.73%. I'm greedy bastards. Let me ask a question. Is 5.73% more or less than you could borrow money right now for just about anything from a bank? If any of you say anything less than less, or wait, I just screwed that up. But if any of you say anything other than less, then you are completely wrong. The bank, you could never borrow money from any bank for less than 5.73 or even close to 5.73 for anything. So we're better borrowing from ourselves, right? From the insurance company. But you see, even if I took all that money out, if I took all 18,000 of that money out, I would have still made 20.4. So how many of you, if you made 20.4% in a vehicle that was mostly guaranteed interest, but to use the money, you'd have to pay 5.73%. Would anyone be mad? Anyone? You made 20.4 just in cash value growth because we did the math. But to use the money, now the insurance company, the greedy bastards, are going to take 5.73. Is anyone upset? Anyone? No, not mad at all, right? You don't care. You're like, well, you guys just paid me 20.4%. That's what I made compounding. And you're just going to, for me to use the money, I got to pay 5.73. Hell, my home equity line of credit's more than that. You're starting to see you picking up what I'm putting down here? Like, this is why the wealthiest families throughout history have done this. This is why we have 16,000 plus clients and nobody's mad at us because it's just mathematics. And now let's jump into some serious behavior stuff. So when we were thinking about what to do here, we wanted to do a case study that was very real and near and dear to home. And in order to do that, I told Craig, I said, the one thing that people really screw up when they're talking about the infinite banking concept is not the fact that they don't understand to put money into the whole life. And they don't understand, or it's not that they don't understand to take loans from the whole life, because they understand that makes sense. We just did the math. Where people screw up, and it's a behavioral thing, is they don't follow through with being an honest banker. So what I mean by that is if you drew a circle, okay, But if we just erase the bottom part of the circle, nothing would ever go around that circle, would it? Because you didn't complete the circle. So we got to complete the bottom part, which is the recycle and recapture. And there's a very, very specific reason why all of you need to be an honest banker. If you take a loan from your policy, this is something I just had a call with a client the other day. He's been doing this 5 years now. And he called me out, or he sent a message. Actually, Stephen got the message. And he said, I don't really know why I'm doing this. Like, I'm looking at my new statement. I'm looking at the math. It just doesn't make any sense. Like, should I just surrender this thing? And I feel like I'd lose a bunch of money if I did. I looked at his statement. I ran the numbers just like I showed you how I ran mine. I'm like, holy crap, this policy crushing it. What I found is that the client, every year, he would put money in, he would immediately take money out. And when I asked him, what were you taking the money out for? He just said, I don't really know. I mean, just to live on. So he was not connecting the bottom part of the circle. So he wasn't being an honest banker. And if you all owned a bank and you took a loan from your bank, you indeed would pay your bank back. You would make payments of monthly principal and interest back to your bank, just like you pay Bank of America for your car loan, just like you pay Visa for your credit card. You're always making a monthly payment to them. But yet when you're the bank, when you're the one taking loans from your bank, you fail to pay yourself back. This is a behavioral thing. So what we're going to do is we're going to demystify that. So Craig, I'm going to turn this over to you. Why don't you roll through Goldie Doe and her debts?
All right, let's get rolling here. So before we jump into Goldie Doe, who is one of my fictitious families, there's Bucky Doe, Goldie Doe, Minnie Doe, there's a whole family of them. But I have a question for everybody. When we talk about using these policies, Chris just went through many different examples, but what are some of the things we can do with a policy loan? Well, Chris talked about, of course, we can pay debts. That was the first thing we talked about. We can fund major purchases. I think I saw earlier a comment by Andy, which I love, because he says, hey, I just found another really cool benefit of using my whole life policy for his college FAFSA. Cash value inside of your policy does not count, towards reducing your FAFSA benefits. So there's just so many cool things with this, but you can also use your policies to fund major purchases. Chris, how do you buy your cars?
Through my own banking system.
And
I make
how does
monthly
Shauna take her
payments every month.
And Shauna does the same thing with vacations. And, so those are, I would consider all of those major purchases: colleges, cars, vacations. And then, of course, we can invest in the things you know, like, and understand. So this is just the place where you're putting your money first and then going to do these other things. But what we want to talk about today is just an example of Goldie Doe and some of her debts. Now you may be in a similar situation. Just kind of curious about the folks on the call today. How many folks here have credit card debts, car loans, personal lines of credit, maybe just different debts out there? We have folks out here that have some debts they want to get rid of. Yep. All right. Well, then tune in to how this works, because I'm going to kind of walk through 3 different ways of how debt can be dealt with. Now, let's just imagine Goldie and her debt situation is she has a Chase Freedom card, and she's currently got $11,987 of balance, and she's making a payment of $299.68, and the interest rate is 18.59%. Then she also has a Visa card with about $6,500 on it and a monthly payment of $162.50 and an interest rate of 22.56. And then Goldie's also she's got a debt on her car. She's got a used Honda, and she financed that at $23,500 at 7.63%. So if we look at Goldie's debts, she has a total of $41,987 of debt balance. But because there's interest charge on there, she's going to pay about $18,000 in interest only, in addition to her principal. And it's going to take her about 75 months. So this is just her picture, and this is how it's going to play out if she just keeps paying debts the way she's always done it. So earlier, Chris was talking about the envelope and Dave Ramsey teaches Snowball. And if you look at different debt strategies, Snowball is out there. It's using the lowest balance of the debt to the highest balance of debts, and you just keep aggregating those. So as you pay one off, you take the payments that you were making and put that onto the second debt. There's another method out there called Avalanche, which is highest interest rate to lowest interest rate. So we're just kind of ordering those debts. There's others out there, cash flow index and different methodologies. But what we do when we're working with clients is we figure out which one of those is the most efficient. We don't care which one is, we just want to know which one is. But in this case, let's say that Goldie uses the avalanche method, which is to order all of her debts by highest rate to lowest. Now, it just so happened when we put her debts in the tool that this Chase card got paid off before the Visa card. So that's why you see it at the top of the list. So in 63 months, her Chase card is paid off in full. So guess what she's going to do? She's going to take this $299.68 and add that to the $162 that she was paying to Visa. So now she's making a $462 payment to Visa for an additional, 4 months, and then that one's paid off. And then she's going to take those two payments and add them to the bulk of her monthly payment on her Honda, which is now she's paying about $870 a month. So what did she do by doing it this way? She saved about 5 months in time and debt. And she did save a little bit of interest, a few $100 in interest, but she was more efficient in her debt pay down structure. So this is what we do every day. When you book call with our team, if you have debt, we'll walk through this whole scenario. We'll take your numbers, put it through our tools, figure out what's the most efficient method. Now, I haven't talked about infinite banking. I haven't talked about the policy at all. This is just trying to figure out how to make your debt situation more efficient. However, before we go to that next step, Chris, you asked earlier, who has emergency funds, and I imagine most of those people that have emergency funds are also doing some regular savings to build that up if it's not built up to where you're storing that. But the real question is, where are people putting their savings? So I'm just kind of curious if people wouldn't mind putting in the chat. Are you putting money into CDs, savings accounts, brokerage accounts? Like, where are you saving your money? It could be a mason jar under your mattress. Where are some of those places you're saving your money? Policies, savings accounts. And Chris, we looked at the whole savings account thing the other day. Traditionally, we're seeing savings accounts can be anywhere from, say, 0.07 up to 0.42. That's kind of the historical 15-year average. But there's a lot of people out here say, hey, I've got a high interest rate savings account. I've got one as well. I keep a couple bucks in. But do you think those are around, you're going to be sticking around for the next couple of years?
No, like Frank just
4 or 5%?
posted, he's got a high yield savings at 4%, but I mean, that's great today. But how
Yeah.
long will 4% last? I didn't see what Jerome Powell said yet, if he's gone live, whether or not he's going to hold rates. I mean, maybe we got another 3 months, of these rates where they're at today, but then eventually, if you've been paying attention to the administration, to what the Fed's been saying, we're going to continue on this downward interest rate slide because that stimulates the economy. So 4% is going to be a thing of the past very soon.
Yeah. So we'll ride the wave while we can. But the real question that I want everyone to think about is, no matter where you're storing your savings, can you spend that money while you're saving it? Can you pay your debts while you're saving it? And the answer is probably no, because if I've got a savings account and I take out $2,000 to throw at debt, am I earning any money on that $2,000? Well, no, I'm not earning any money on that $2,000 because I took it out of the savings account. So when we look at the most common place to store money is typically a savings account, a bank account. I think Shauna put this graphic together. I love it because it's really just saying point by point, how do we compare a bank to a policy? So if I put money in a savings account, it's liquid. If I put money in my whole life policy, it's liquid, not 100% initially, but it's still liquid. So when we fund policies, we always say within 30 days, we have a percentage of that will be coming out. The next point down is, are our savings accounts guaranteed? Do they guarantee us an interest rate? No, they're variable, right? So, and this says 0.07, but it could be 0.42, it could be 1%. So we know that fluctuates over time. Right now, we're happy because they're 3 and 4%, maybe 5%. But when we look at the policy, there's guarantees in there. And Chris was talking about this earlier. There's guarantees in the contract, and that most of the companies we work with are anywhere from 2 to 3.25. But then when we throw on dividends, we can see 5.5, maybe up to 6%. But here's the thing: it's uninterrupted compounding, where we can still take that money and pay debts. We can take that money out, invest it. We can take that money out and use it for major purchases. So that's that whole circle that Chris was talking about earlier. And we're at that time of year when we're all getting those 1099s in the mail. The bank account, on the minuscule amount of interest that we're earning, we get taxed on that. And then we get that in our 1099s. However, on the policy, all of this is growing tax-free. I've never received a 1099 from any of my policies. Of my oldest one's 15 years old. I've never received a tax document for it. And then when we look at protections, and this kind of varies from state to state, but if you were ever sued, the money in the bank is easy pickings. And if you have money inside of your policy, and depending on what state you're in, there are some different rules, but you have more protections on your cash value and your life insurance than you would with cash just sitting in a bank. Now, this next one, over the past, few years, we've seen some bank issues. We've seen some bank failures. We've seen them over time. But I love looking at the history of the life insurance companies, the mutual insurance companies we work with. And Chris, can you remind me, I mean, most of the companies we work with have been in business for well over 100 years. How many times have they missed paying dividends?
Not once. None of them have missed it, not once.
So you're telling me during the Great Depression, they were paying dividends?
Yep, they were. And through the Great Recession and through the Black Monday and all the other recessions like the dot-com crash, paid dividends. Through the pandemic, paid dividends.
Yeah. It just blows me away when I look at that. But then this last step is the death benefit. We're not going to get a death benefit in our bank account, but we will with our policies. And Chris, I know you have these conversations often. I have them often as well, but people will say, isn't it more efficient for me just to take money from my savings and invest it? Won't I make more in the short term? I mean, in the first couple of years, won't I make more money that way?
Well, yeah, you would.
And you will, because you've got the full amount, and with the policy. So what we have to think about is short term and long term. We know, because we've done the math and we've done several use cases, but over time, in the long run, the policy is always going to outpace paying down debt, investing, or major purchases with the policy. So here's the way I look at it. Let's say it takes you 5 years, 4 years, whatever that's going to be to cross over and have a more efficient system in the policy. If you think you're going to live longer than 5 years, I'd say go for it, because you're going to be happy you did. If you don't make it in those 4 years, your family is going to be, from a financial perspective, protected because of that death benefit. Whereas if you're in the cash side only, you don't have that death benefit. So I don't really see a downside to that, unless you're someone that just doesn't care about, taking care of your family after, some God forbid something happens to you. So those are just kind of the differences that we tend to look at between storing our money in the bank or the policy. But let's see how this can actually work for us, because what if we take that debt situation I just went through with Goldie, and she does the avalanche structure? So we're going to keep doing the avalanche. So let's just say that Goldie is saving $500 a month, and maybe she was putting that in a savings account. It doesn't really matter. But now what we're going to have Goldie do is just put her savings into this specially engineered and designed whole life policy. It's not something you're going to walk down to State Farm or, Prudential or whoever and have them build you a policy. It just has to be a specially engineered policy. But Goldie's going to put her money into that policy, and it's going to compound and grow regardless of whether she's taking a loan or not. So now what she's going to do is either monthly or quarterly, it just depends on how you want your money to flow. She can take the loan out, and she's going to throw it on top of the debt payments. So remember how she was paying on her cards? When one card was done, she was going to take the payments and just stack them on top of each other. Now we're throwing more fuel on the fire, because we're throwing the policy loan on top of it to pay the debts down faster. Now, she still has to pay her debt servicing. Just because she's doing this infinite banking structure, she still has to make her minimum payments. So some of that's going to come from income. But look at what happens when she adds that extra fuel to the fire. Who can remember how much interest she was paying before we used infinite banking? Do you remember the number? Anyone out there? 18K. Marva comes in for the win. It was about 18K. So now she's cut her interest charge that she was paying to Visa and to Chase and to the car dealership in half. And she went from 70 months to about 40 months in time that it took to clear out all those debts. So guess what? In 40 months, she no longer owes Chase any money. She no longer owes Visa anything. She no longer owes the car dealership. She's completely wiped out those third-party debts in 40 months. Now, I'm going to stop here because a lot of people will say, well, wait, this isn't the whole story here, because you were funding your policy and you were taking money out of policy. So don't you have a loan to pay back in your policy? And aren't we talking about becoming an honest banker and paying our system back? You're absolutely right. We have a policy loan to deal with now. So think of it this way. A portion of those debts have now been moved into the policy. And the way I like to think about it is I'm now in control of paying that back. So if I have a bad month and I can't pay the whole 870 of debt payment, great, nothing bad's going to happen. But if I can, I'm going to continue to do that because that's the thing we want to do when we're being an honest banker. Now, there's some comments about, hey, sometimes having loans helps your credit score, but if you're trying to get debt off of your credit score, just kind of move it into the private side. The policy loan is never going to be part of your credit score. They're not going to look at that. So that's more of a private thing. And I love how the savings continues to grow and compound while we're paying off debts, and we have that death benefit is what we talked about earlier. So now here's the thing. We have a policy loan, and let's just say for our use case that the insurance company is charging us 5% on our loan interest. We have a loan balance inside of our policy of $17,678. And if we're an honest banker and we pay that $870 back, that $869.98 every month, we're going to do that for 22 months, and everything is now paid off. So remember, our third-party debts were gone in 40 months. We can pay our policy loan off in 22 months. And so that's what, 62 months. So we're still faster than just doing the avalanche, and we let our money compound and grow in the policy. So everyone's with me so far. We have a loan of $17,000. We have to take care of at 5%. So let's see how that kind of works out. All right, everyone listening up, because I have a little question. It's a trivia question. So now let's assume that Goldie has this policy loan of $17,678. And we already know her interest charge is 5%. What will her total interest charge be for the first 12 months? And let's just assume she's not going to pay anything towards her loan. Who thinks that A is correct? Will the loan interest be zero because Goldie gets all of her money back? So is it really a $0 interest charge? Or is it going to be 5% of the 17,000? So she's going to be charged about $840 in interest. Or does it depend on her effective tax rate? Or it doesn't really matter because the insurance company is going to charge her extra fees, and it's going to be about $1,250. So A, B, C, or D? What do we have? Well, I got a bunch of B's, a bunch of B's. Oh, we got some A's here. Well, let's let the drum roll, because the answer is B. If Goldie does not pay her loan back, there will be a 5% loan interest on that $17,678. So it'll be about $840. So congratulations to everyone that got the answer correct. You still have time if you missed the first one. Here's one more. Now we're going to add one element to this. What if Goldie starts paying $870 a month towards her loan? Will she still have $840 of interest? Will her loan interest be zero? Will her loan interest be less than 5% because she's being an honest banker? Or will we still be stuck with this $1,250? So let your answers roll in and let's see kind of what we have here. So Chris, we have a mixture of B's and C's here. Some people think the interest is going to be $840 even if she's paying the loan down.
No, this is when I was talking earlier, this is like that biggest thing that people don't know, because in their mind, they're like, all right, the interest is 5 or 5.5. That's how much I'm paying. So they're assuming that even when you're paying the loan back, you're still paying the same amount, but they're not doing the math. So Craig, you want to show them how math works on this?
Yeah, so here's the answer. Her loan interest will actually be $601. So instead of it being $840, because she was an honest banker, it's $601. Now what we're doing is if we take that $601 divided by our loan balance, that comes up to about a 3.39% interest rate. So when Chris was going through the examples earlier, and remember how his friend was taking money out of his bank, he was growing at 6%, but he was taking loans at 4%. Chris, you just wrote up there, it's like 2% spread, right? Is it really a 2% spread, or is it bigger because you're paying that loan down and the loan interest rate really wasn't 4%? His loan rate may have been 2.
Well, remember, it's bigger.
It's even bigger.
Yeah, but I was just trying to give a general synopsis from surface value, but a lot of times, like, we're just showing that so that we get your mind thinking that way. And then actually, when you really see the numbers, it's more and more and more and more.
Yeah.
More.
Yeah. So I love it because when we're talking to folks, they'll say, why in the world would I want to pay 5% to use my own money? And they're missing the point that it's all compounding and growing. And if you're being an honest banker, you won't be paying the 5%, you'll be paying something less. So here's kind of how it all nets out. Remember option 1, where Goldie paid off all of her debts one at a time. And this is what I consider most people do, is if they have debts, when they're done paying the credit card of, and it had $162 of payment, most of them go spend that, go out to eat more. They blow it. They don't use it to aggregate onto their debts. So if Goldie were to pay her debts off that way, it's 75 months, $18,384 of interest. If Goldie simply uses the avalanche sequence, where she's going to aggregate all those debt payments, she's going to knock off about 5 months of her debt cycle and save, I don't know, probably a couple $100, if that. And here's the one I really enjoy, because option 3 is she's going to use the avalanche, and she's going to leverage her savings that she put into her infinite banking system, her specially designed whole life policy, and she's going to use that money to accelerate her debt pay down. So remember, she's paying all those third-party debts off in 40 months. And for the next 22 months, she's just running that same debt payment back into her policy. So net, she's got 62 months and she's completely debt free. She saved over, from 18,000 to, 9,000. So she saved almost $9,000 in interest. And so this is how that system works. This is how that whole plan works out.
I think one of the most important things here, Craig, is not, like, yes, it takes you less time to pay off your debt, but really you get all the money back, because in doing the policy, you're paying yourself back instead of paying somebody else. I know you hit that, but I just want to reiterate that when you're doing this, I mean, just look at how little you paid in interest compared to the other 2 options, which is what everybody else is teaching, like the avalanche or the snowball or anything else, where here it's changing where the money went first, adding that one step, which is the infinite banking concept. And that's a huge difference. Huge difference.
And I don't know if anyone caught on to the title of my slide, but I don't know, I thought it was a little clever. The interesting facts.
So you called it out. I didn't pick up on that.
Yeah. Well, a color green, maybe someone will pick up on. So that's what we have for you in terms of the use case. As Chris knows, I've got spreadsheets that can show loan calculators and all that jazz if we want to go through those things, but wanted to try to keep it simple today and just show, there's different options for how you pay down your debts. And look, this is just one example. If you're investing, the same thing's going to happen. We're going to have this money in our policy, earning money while we're, sending it out to work and earning more. And so the process works, whether it's debt, major purchases, investing, is just how the math is going to work out over time.
Did anyone have any questions on those numbers? I mean, it's pretty self-explanatory. I mean, we keep saying this over and over, Craig, it's just mathematics. Like, everything we're doing is mathematics. Sure, you can complicate it. You can be like, oh, well, what's the cost of the insurance? And we have a lot of people that do that. Like, I want to know what's the cost of insurance, which we can show you. But like, if we show you the mathematics, that includes the cost of insurance. It's not like we can dissect the numbers and like show it and then be like, oh, well, the cost of insurance on top. We can't do that. We have a compliance officer that would be on us like that. So everything we're showing you is direct from the insurance company illustrations, and all we're doing is just showing you the mathematics. And the biggest difference here, and the biggest thing you need to understand, is that behavioral thing. We're so used to just looking at what we've been told to do with money that when you see something like this, yes, it sometimes seems too good to be true. When you see 20.4%, maybe that to you seems too good to be true, but it is just math. I literally did it right from my most recent statement that I got. Craig, all those numbers he did right off of illustrations we created on the insurance company's websites. It's not too good to be true. It's just, we need to understand that this is the truth about money, and everything you've been told is some variant of that. And a lot of times what you've been told was solely to get you to give up control of your money so somebody else can use it and make a spread. Here, you're making the spread. And I know some of you are like, yeah, but the insurance company's making money. Absolutely. These insurance companies make tens, if not hundreds of billions of dollars. They're making printing money, basically. But you want them to. And you know why? These are mutually owned life insurance companies. If you Google that word, mutual versus stock, okay, you will understand that a mutually owned company is aligned with your goals. Remember I was talking over here about the dividends? So actually I didn't say that. On my policy, I'll just read this really quick. My dividend on this policy in the third year was $3,685.25. Right there and highlighted. I know it's hard to see, but that was my dividend. You know why I get a dividend? Dave Ramsey will tell you, oh, those insurance companies, the dividends you get, it's just a return of that unused premium that they ripped you off with. Damn, Dave. Like, the insurance company can gladly send me the unused premium deposits that they got every single year for as long as I live. And because they're a return of unused premiums, not a return of companies' profits, maybe I shouldn't say this, but it makes them tax-free. Yeah, because they're just a return of premiums that you shouldn't have paid the insurance company because they overcharged you. The insurance company overcharged you, them dirty, greedy bastards. But because they're mutual, they just give it back to all of us in the form of dividends. And the insurance companies are pretty darn good at investing their surplus assets, which are hundreds of billions of dollars, because they've made guarantees 60, 70, 80 years into the future. So they can't take the risks that the banks and Wall Street do. Like Dave Ramsey wants you to put all of your money in mutual funds and pay high expense ratios and 12B1 fees to the mutual fund companies. Oh yeah, and then there's his band of get-along gang advisors that the only reason they're get-along gang advisors called Dave Ramsey's elite group of financial advisors because they... Actually, Craig, you want to tell them why?
I think they paid to be in the club.
Yeah, they paid to be in the club. They paid Dave Ramsey to say, hey, you should use one of my elite financial advisors because that keeps them paying me every single month and allows me to do, yeah, anyway, you get the drift. So I don't know where I was going with that, but it's just simple. Like, you want these insurance companies to make money because then you make more money because it's mutual. That's a beautiful thing.
One thing about that dividend you're talking about too is if I'm paying $10,000 of interest to the bank on my car loan, how much of that interest did I benefit from?
None, zero.
It goes to the stockholders of the bank, right?
That's correct.
So if I had, let's just say that we paid $10,000 of interest to the insurance company, how do I participate in that? Does that help me at all?
Absolutely. Yeah, I mean, everything helps you. I mean, the insurance company's interest they make on their treasury bonds, the insurance company's interest that they make on lending the money to those broke-ass banks. I'm just kidding, but lending the money to the banks to build these big skyscrapers and more branches. Because where do you think all that money comes from? I think people literally think that the banks use their profits and their money to buy and build those branches in those buildings. No, the banks are going to the insurance companies and borrowing money to build their skyscrapers. Why? Because the insurance companies actually have money. The banks have your money. Big difference, folks. Big difference.
So it's just interesting to think about when you take a policy loan, when I take a policy loan, we're actually helping each other because that's all part of the insurance company making more money and then sharing it with us in terms of, cost reductions, all the things they do. It's that the extra premiums that they didn't need because of death claims and being efficient. Well, it comes back to us. So in a roundabout way, some of that comes back to us.
But Craig, this is an interesting thing that I got to bring up. I guess I'm going to be hitting below the belt here, but all those IUL policies that we keep hearing about that all these advisors saying are way better than those whole lives. And, we get beat up every single day on YouTube and Instagram by these IUL agents saying, oh, that's stupid. Why would you put your money in a whole life? Put it in an IUL. We'll beat the numbers. Do you know that those IUL companies, almost every one of them are stock owned? So if a company's stock owned, who's priority to a stock owned company? Is it the policyholders that bought the IUL? No. It's the stockholders, the shareholders that they care about. So they're not mutually aligned with your goals. They're mutually aligned with the stockholders and the shareholders' goals. because that's who they got to report to at the end of the day. So therefore, because of that, then that would mean that the IUL is really designed to benefit the insurance company and take risk off the insurance company. So if they take risk off the insurance company with an IUL, well, then who's holding all the weight of the risk? Well, that would be the policyholder, right? Yeah. It's an interesting flip. You see, with a mutually owned life insurance company and a whole life insurance company, the insurance company takes on all the risk. As a matter of fact, and you guys can all look this up, like I'm telling you factual stuff, so Google it, fact check me, chat GPT me. Please don't, what is that Chinese AI company? Don't do that with me, because who knows what that thing says anyway. But look it up and look it up specifically about IUL policies and who the risk is on. Like, look it up. And you will find the truth. You will find that like IULs benefit the insurance company more because they put all the risk on the client, not the insured. And whole life policies put all the risk on the insurance company. Therefore, the client takes on none of the risk, hence the guarantees. But to wrap it all up with a little bow tie, the insurance companies, the mutually owned insurance companies, when they sell a whole life policy, they don't make any money on that policy from you and your premiums for at least 5 years. Chat GPT, that one. Interesting. So they are in it for the long haul with you. And that is a very important thing when you're looking at who to do business with. Frank put up in the questions, and I can't understand this one. On TV advertising for YREFY, invest 10.25% monthly. I'm not quite sure what that means. Steven, do you know what that is? Frank, can you explain that a little better? Because that doesn't make any sense to me. But anyway, I want to go through while Steven's kind of dissecting what Frank was trying to ask us there. And I want to just give you the key takeaways that you got here. So kind of the whole sum up and the full circle of what you just went through is your financial habits are already in line with the infinite banking concepts principles. They are. You're already doing it. It is just behavioral. It is just how you do it that's different. And I think that was a really good observation that Shauna put on these takeaways. And she also said, by redirecting cash flow into IBC, again, no new monies. This is the exact existing money right now that you're investing, saving, putting somewhere else. You're putting it in some other account. We're not reinventing the wheel. We're not saying you got to go work harder, longer, take on more risk. We're just saying redirect cash flow that you have now. By redirecting it into IBC, you're building liquidity, control, and uninterrupted growth. And the last thing she said is a key takeaway is reinforce this. You don't need to change who you are. You just need to do a better system to work with. You need a better system. And infinite banking concepts is that system. It is a process. It does not have to be the product. Too much emphasis is put on the product. And I know I have a tendency of talking about the product because it's tangible, it's fun, it's easy to talk about. But where do you become wealthy? In all of Craig's numbers, he just said, what was the differentiator that made the difference there? The process. That was the difference. The system, which is called the infinite banking concept. And here we just call it BYOB, become your own bank. And I'm gonna basically let all of you know if any of you have interest in this. If you want to dive into this, you want to talk to one of our mentors about how this would work for you, and many of you already were, we've been doing it the whole time. We're gonna put a link up there for you to book a call. And the call can be about anything you want, paying off debt, buying horses, buying cars with this, paying taxes with this. I just had a great conversation with sorry, I go down these things, but right before this, I had a client who's been with us for 3 years, or 4 years actually, 4 years. And he took his policy out to pay his property taxes. So how he does it is every month, the money that he would have paid to the property taxes, he just saves it in the policy. At the end of the year, he takes a loan and pays the property taxes, continues, paying, saving, and end of the year takes it out and pays the property taxes. And then when the property taxes go up, he increases it. And how he did it is he said, listen, he said, by doing what I'm doing here, I'm gaining all that interest in his, and we ran the math on it today. But he also said one other thing that's even more important. He says, when I'm gone, when I pass away, all that death benefit is going to pay those taxes for my kid's life. Like he's like, the taxes will never exceed the amount of the death benefit. So he says, number one, it's a more efficient way for me to pay taxes. But number two, when I'm gone, which I will be before my kids are, they basically got their taxes paid for the rest of their existence. And I thought that was a kind of a cool way to look at it because it pulled in, number one, the uninterrupted compounding interest, the infinite banking concept, but then put a lot of emphasis on the real why, which is the death benefit. And I think that's something you all should focus on. So book a call with one of our money mentors. And in closing, I'm going to give you the quote that Shauna gave me to read to you. And I love this. This is from Steve Jobs. The best way to predict your financial future is to create it. And to create it, let's do it together. Thanks, folks, for joining us for the Wealth webinar. Thank you, Stephen and Craig, for being here and all your extra effort you put in. And Shauna, thank you for putting together these amazing new structures for the Wealth webinar. Folks, if you like what you saw, if you really, really like this new format that we're going over in this year, give Shauna a shout out. Tell her thank you, because this is all her, Shauna, and Stephen who are putting this together. I'm just the puppet that gets to sit here and talk. But you know what? I'm having a lot of fun doing it. I love the scripts, and I think we're really, really getting down to the root reasons why folks need to change how they use money and how their money works for them, and that's what we're bringing to you. So thanks, everybody. Sign up and make sure you subscribe to that YouTube channel, because this afternoon and every Wednesday afternoon, we do Ask Me Anything Happy Hour, which is where we get along, or like our Get Along gang, our Brady Bunch, if you will, of mentors get together to answer your questions. And today, folks, there is going to be a special guest. She is a whopping 4.5 years old, and she knows how BYOB works. And not only that, for the first time in her life, she has saved up enough money to buy the Paw Patrol aircraft carrier. If you want to talk to the Vivi, the one and only Vivi, who saved up money and is using her banking system to buy her Paw Patrol aircraft carrier, she will be on today for the Ask Me Anything Happy Hour. But to get there, you're going to have to be subscribe to my YouTube channel at the Chris Naugle and click that little bell so that you're notified when we go live. We'll see you this afternoon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.